Hello and welcome to Options Guide TV. My name is Brian Overby, the author of the Options Playbook, and your host for about the next, I'm thinking only 15 minutes today. We're going to rock and roll this Options Guide TV. We're getting ready for next week. We'll start out with a trade on Monday. I didn't want to put a trade on in the SPX over the weekend. I would prefer to wait to do it on Monday. And dare I say, well, we'll decide on Monday if we want to get bullish or bearish with our trade. I'm still just looking at weekly trades in the month of September, a little bit leaning into October before I don't like, as far as new positions are concerned, if I had a chunk of cash that I wanted to put in the marketplace more as a longer term investment, I really want to wait until that unknown event I guess it's a known event in November, the presidential election. I think after we get that out of the way and get that uncertainty out of the way, it will help quite a bit with the markets. And that's when I would want to, if I had income to invest, that's when I would like to invest it. Now, if you took that strategy and you did it in the NVIDIA and you blinked, well, guess what? NVIDIA is back up again, trading almost at 120, up something like 20% over the last, I think it's 3 weeks or 4 weeks. So NVIDIA right now is at 119.50. We've been selling put spreads, which is a bullish trade, and taking advantage of the fact that the volatility was, spiked in NVIDIA on its way down. So there were some premium in the option contracts, but in hindsight, hindsight, as they say, it's always 2020. That was the wrong strategy. We should have been getting long call spreads or call debit spreads or bullish debit spreads in NVIDIA, as opposed to just selling these measly little put spreads that keep expiring worthless because NVIDIA keeps doing leaps and bounds. I also didn't mind doing the short put spreads as much because I wouldn't mind buying the stock. If the stock came down to that level, I was okay with it. As a matter of fact, I did add NVIDIA to the portfolio, not at the very bottom of this downturn, but down around the 110, 111 mark. Bought some shares for a retirement account, and with the plans of dollar cost averaging into a position. But once again, I turned around, and before you know it, there is NVIDIA had jumped 10 points or 10%, a little less than 10% at that point in time. So let's review we did an NVIDIA trade on Monday, went out worthless by Wednesday. I think we closed it for a nickel, and then said, well, why not do a rinse and repeat? The market is strong in it. Volatility was still high. It's still trading fairly high on the short-term averages, but if you go a little bit longer out in time, and implied volatility is coming back to its historic average in general. So let's run to the Tradier Pro software and let you know that if you have any questions, please do feel free to put them in the chat box. We will try to address them on the show. They could be specific to the trades that we are talking about or that we have done on Options Guide TV over the week, or we could look at one-off topics. If you have a specific stock you'd like to toss in, we have time today because I'm only going to go over these trades in NVIDIA and in the SPX, and I don't want to put on a new trade today going into the weekend. All right, so here's showing you how much implied volatility has dropped. We've had, and this is a beautiful thing about a short put spread, is that the market goes with you. Implied volatility has a tendency to go down when the markets are going up, and that's what you want to happen, and that's what happened here. When we first put on this trade, now ignore the 0-day option contract. These are the ones we're trading, but implied vol kind of gets screwed up on the very last day of trading. And you look at the SEP 20, 7 days out, 51 IV historical is around 51. SEP 27, 51, 51. So the skew, as a matter of fact, the vol is actually below the historical going out into the end of October. And vols have came, I guess, if you think of it this way. They've came back in line. They're no longer elevated relative to the historical vol. Okay. So our trade that we did, let me grab the strikes here. We sold the 104 and bought the 101. I'm not even going to put it in here because we're so far out of the money. 104, we didn't even get a chance from Wednesday to Friday to actually be on the show and close it out for a nickel. So it looks like they're just going to expire worthless. We did that for 30 cents. We had 3 points of risk total minus the 30 cents, or $2.70 for every 1-by-1 short put spread that we put on. But I guess it makes sense for me to just show you what the trade was. Let's click on the bid. That's what we sold, and click on the ask. That's what we bought. And this is what our short put spread was. Net credit of 30 cents for that trade on Wednesday. Okay. Now, as I mentioned, I did buy some shares in a longer term account in NVIDIA. And you think about it for a second or two and you say, well, it's made a 20% move from its bottoms, from its recent bottoms, almost 20%. And should I be selling a call on it? We still have obviously decent premiums, implied volatility trading right around 50%. I mean, Apple, for example, would be about 20% on a relative basis to a Meg 7 stock. So you're going to get some juice for them. So even going out 7 days, and let's clear this and look at it on the 7-day basis, like we can go 127. We're almost one standard, well, 20 delta, and you can get $1 for that trade at 127. Now, it doesn't sound like a ton after the stock has gone, well, in a couple of days from 110 to 120. So if I were to do a call on this position, if I were to sell a call, which I'm not that excited about doing in general, I don't mind doing it now. Still in September, stocks, overbought in the short term. I don't mind it, but I'm going to show you the way that I would do it. If I were to do this in NVIDIA, the trade that I would consider is actually a ratio spread. And to me, it's a covered call on steroids. And in most stocks that I'm just trying to generate income on, I don't want to do this. But if I'm going to do this in NVIDIA and the market is coming up to my short call strike, well, rolling that position just kind of annoys me because you're kind of like, why did I do this? The stock has, one of the best I don't know if at this point in time it is the actual best performer for the year, but if not, it's in the top couple of companies that are. And why am I selling a call and capping my upside? If you do the strategy that I'm going to show you, and as a matter of fact, you know what? Let's pause. Let's come out for a second. And I'll show you the strategy inside the options playbook. But it's not as a strategy where it's not a strategy inside the playbook that actually has stock with it. It is called a back spread or a front spread. Front spread. Okay, and here we go. We're let's swap this out. And pull up the options playbook. All right. So here's what the front spread is. If I'm looking at the front spread, now realize we don't have stock in here. We're going to throw stock into the NVIDIA trade that we're talking about. And I do think everybody should have this strategy in their toolbox. And it's a little scary because you're doing a ratio, not much different than a butterfly. But one of our legs is going to actually be the stock as opposed to all options in a butterfly, right? It looks kind of like a butterfly. You have the TP in the middle, so you're buy strike A, you're selling strike B. As the market goes down, though, we don't have a strike C, or this would be a butterfly. And the issue here is that you have unlimited risk if it gets beyond this break-even point right here. As the market goes up and up and up, this strategy loses more and more money. Hey, now you flip the script and you put the stock in, and what happens is this thing kind of tilts a little bit. I think you'd go like this, right? And as the market goes up, you own stock. So from strike B on up, you don't lose anymore. And as a matter of fact, from strike A to strike B, it's like you have owned the stock on margin. You are long an additional call spread. And from strike A to strike B, it's like owning 200 shares of stock. So if that does happen to you, you get rewarded enough that you can say to yourself, all right, I'll buy back the other call, close out the long spread. And if I want to roll it, I can roll it. But this gives me a profitability from strike A to strike B that I didn't mind bringing in a smaller amount of premium to do the trade. Okay. So this is without stock. Let's go on in and look at the profit and loss graph now. We can stay there for a second. In Tradier, where we'll probably go out 14 days here because we do need a little bit of volume. We're going to sell one and buy two. The one standard deviation move, that's what we have highlighted here in the Tradier Pro software. It's where the shading kicks in. Delta is 20 right here at the 131 strike. These are the puts on this side. Stock is right at 120, highlighting the most at the money option contract. So if I owned 100 shares of stock and we sell this option contract, which is the 127, and we're going to buy the so let's do this one. Buy that, and then we're going to sell two of these. 35-cent net credit. Let's do 131, but then that's only going to give us 3 points. Okay. I want to get a little bit more than that because here's what I'm targeting here. If I were to sell a call in here and I was just selling a call, I'd probably sell something right about one standard deviation away, right about where this gray line is, and that would be about $1.11. All right. We're going to give up some of that premium in this trade the way that we're going to set it up, and I'll show you the what if calculator as soon as I get it set up here. But I don't want to get only 35 cents, only a third of that dollar that I was looking at. So let's get a little bit more, and we can make it about 40 cents or closer to about half of the net credit that we would receive. And we do that by just moving in a little bit here. So we're going to take this out, get rid of this. And we're going to sell two of these. Now, the downside is that our spread isn't as big. So you're looking at 3 points as opposed to 4. And that does matter a little bit. Now we're bringing in 63 cents as opposed to if we sold this one outright, we would do $1.25, or the one that I would have focused on, which is the 132, is $1. But we're saying we give away our stock at 131. That's a 20 delta, 20% chance. At this point, if you ride it for the 14 days, that the stock would be at least 1 cent in the money, or we would basically get our 100 shares called away. And let's go and send this to the what if calculator. And you'll see that this looks a lot like the profit and loss graph that I just showed you inside the options playbook. Now, if we go over here, go down here and equity. There we go. Add equity. There's where we want. Okay. So now, as soon as we add that 100 shares of stock that we're talking about, Notice we just tipped that whole equation. And let's go back and do that again, and let's watch. Okay. So if I'm doing the front spread or the ratio vertical spread, and I do it without owning the stock, that's a scary profit and loss graph, especially in a stock like the NVIDIA, right? Stock's at 119 all the way up to here. We look pretty good, but then from there on down, we have substantial risk. We would be considered naked that call option. But if we have NVIDIA already in our portfolio, let's add the stock. This would be as of today. If we bought the stock at 119.49, that would be where we would be at. Now the whole graph switches up, and you see it now from 131 on up. That 100 shares of stock protects us and says we have limited and known upside. Now, from 128 to 131, for those 3 points, it's like we're on stock on margin. The rise over run is 2-to-1 for every point that it goes up. If we're at expiration, and the delta would be fairly close to 1 on our long option contract, for every point that it goes up in the stock, we grab a point in the option contract, and that gives us 3 points. So if the market does run all the way up, we're pulling in 60 cents as opposed to going up one strike and maybe selling it and bringing in $1. So about half of the premium. But we can make $3 from 121 to 131. So if the market starts coming towards your strike, you can kind of ignore it until it gets there. And if it gets to 131, well, then you're going to have to do something. So the moral to my story is, if I'm looking inside the options playbook, and I'm always here on Options Guy TV trying to take situations where the 40 strategies can be used. A covered call on Apple, don't really want to do it. Implied volatility is too low. It's got a little bit more predictability on the stock. I don't expect Apple to double over the next year, but NVIDIA could, and it could go down, right? It could get cut in half because the stock's had such a big run up. So I'm not trying to imply that NVIDIA is just going to go straight up, but I think if you've been in the markets, you would feel the same about what Apple can do over the next year and about what NVIDIA can do over the next year. So this would be my version of a covered call in NVIDIA. Totally different than my version of what I would do the standard covered call if I was looking at Apple. That's the way that I would approach it. So I'm not going to really come back and look at this trade. Like I said, I added some NVIDIA to my portfolio. I've had NVIDIA in there for a couple of years now. But I did decide to add some more to the position on the downturn. I was hoping it would get somewhere near 100, actually, is where my target price was. I sold a put at one point to try to buy it there, and I missed. And then I got to 110, and then I started to panic because I knew that I didn't get it at the bottom. And so I bought some, and then the next day I woke up and it's 10% higher at 120. So crazy stock, crazy market. That's where we're at. Any questions? We do. Hey, Wayne, nice to see you. All right. I sold NVIDIA short strangle with a 95 put and a 32 call when NVIDIA was at 107. And do the next expiration before it gets breached. Okay. So I guess I'll read this in entirety. Hey, Brian, I sold an NVIDIA short strangle with a 95 put and a 132 call when NVIDIA was at 107. NVIDIA has rallied 12% from 107. It's rallied a little more than that, actually. Would you roll the 132 call up to the next expiration before it gets breached? How many days? How many days do we have, Wayne? And here's one of the things that I might do. Okay. So let's throw that out there. I collected 97 for the 315. All right. And how many days are left? How many days are left? What expiration? What expiration? So this is a good question. Okay. So you collected 97 for, the October 18th. I see it. October 18th. So you went out quite a ways on this. I see it. 35. October 18th. I didn't see that. Selling the October 18th. I got it. Okay. All right. So you collected that. You got 35 days. It's now at 32. Okay. One thing that I would do to try to help this out. Here's a strategy. If I would do first of all, I probably would have done a condor or split this up. So in other words, I'm doing a short call spread on the upside and just selling a put on the downside. The strategy that Wayne did is sold a put on the downside, saying, I don't think the market's going to get down to this level, and then sold a call on the upside, thinking, I don't think the market's going to get up to this level. Okay. When that happened and the put, it runs away from the put, I don't mind rolling that put up and rolling it maybe even down a week and saying I'm going to buy to close the 95s, and then I'm going to sell the 100s or the 105s or somewhere in that range, depending on the premium. You can stay in the same expiration if you want to do that to keep things simple all the way to October 18th. That's just a long time period for me, especially in September and October. But it's all about the premium. Then that gives you a small net credit. Now, I don't mind rolling up because some time has passed. And that means the probability of it going back down to hitting that strike is lower, because if you're doing the math, you have less time for that stock to move. So I don't mind looking at it that way, where I would roll the put up. You're talking about rolling the call because you're nervous about it, but let's generate some cash to help maybe pay for the debit on the call. We're at 32. You want to go out in strike. I don't know if I would adjust it at this point in time. I don't mind adjusting the put up right now, but I would probably think about waiting until I got a little closer to that strike price. And if we look at the chart, I know 32, I think you were probably looking at the chart. 32 would be like a new recent high, I think, in NVIDIA. And I'm just going to pull that up real quick. Yeah, right up there. So that's where you were targeting it, right on the 130 when you sold the 132 call. Yeah, I think I would be a little bit more nervous if I got to the bottom of this channel here, 125. So I'd give it a little bit of room, maybe roll that put strike up, bring in a little bit more premium, and then think about when I got to 125, I would worry a little bit more about the rolling. And I would definitely, right around 127.50, 128 is where I would definitely roll. That simple. There you go. Did you get all that? Well, it's recorded, so you can go back and you can look at it. But I like, if they've gone against me, and I do this more so on an iron condor, is grabbing the short spread of the iron condor and rolling that up, because that's a winner. That's a winning trade. Time has gone away. Probability of it moving down through that strike on the downside has decreased. So let's bring it up and keep it at maybe the same probability that it was when I first put the trade on. And then also bring in some cash. Don't mind doing that at all. And you can do it again. You went out far enough in time that you can collect it and do it again. Any other questions then, Wayne? No. All right. Good. Well, our other trade now. Let's look at closing out our bearish trade in the SPX. Didn't work out. That simple. And we should have adjusted it on Wednesday, and we would have been okay. We looked at it. In my own personal account, I did adjust it, and I only brought in a net credit of $1.75. So I lost 75 cents on my trade. I paid about $2.25, fairly close to what we did on the show. And I rolled, and I have right now a short put spread in the SPX for 1 day. It's going to last for 1 day. But here's what our trade was, and we just didn't have the opportunity to do it on the show. We talked about it on Wednesday's show. Probably should have just did it at that point in time. But once again, hindsight is 2020. Here's what our trade was. Show it. And this is why I don't want to put a new trade on today. I want to decide if I want to be bullish or bearish on Monday. But we were in the 0 DTE option contracts, and the market's at 56.25. When we did this, we were at 54.33. So it's been a fairly strong rally in that since we put the trade on. 53.90 is all the way down here. 54.15. Okay, so let's go all the way down to this. And I froze. Well, you can obviously see we're at good, we're moving again. 54.15. Nothing left of it. Okay, so we bought this. Market was at 54.33. We bought the 54.15, sold the 5400s, and then bought the 53.90s. The adjustment was to sell the most expensive option contract, which would have been the 54.15, and buy to close a 5400, leaving us in a short spread. And that's the trade I did. And I did it on Wednesday, and it ended up I ended up getting it done for a net credit of 175, left me in a 10-point wide short spread as many times as I had the trade on, and I lost 75 cents on the trade. On this one, we would have lost the entire amount because we didn't adjust it. We just didn't put an adjustment in on Options Guy TV. Still didn't mind the trade. Still find it interesting. Still might want to do it on Monday. But I'm going to let the weekend ride and see where we're at. I guess you know what? I feel guilty when I just assume that people watch Wednesday or Monday's show or Wednesday's show. So here's where it is. And here's this. All right. That was the trade that we had on, and we started that trade on Monday. And it looked like this. So we had upside if the market went all the way down, if it blew through our strikes on that situation. I rolled it right about here, 5,400, 55.40, somewhere around there. I think so. When was it? And then here's where the market's at right now. So we're not even close. We're not even in that range. That's simple. Any other questions? Well, I thought we were going to be short and sweet this week, this Friday, but I guess we're not. So it is time, exactly at 11:30 Eastern time. Have a great weekend. We'll come back, and like I said, I'm not going to try to get long any particular positions. If you're thinking about NVIDIA, I gave you a great alternative to a covered call today, and we'll see you this Monday for the next edition of Options Guy TV. Please share with everybody. Let them know.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.